Hi class, today's lesson is going to come from chapter 20. We're going to work problem 20-1B. And what I've done is I've created an Excel spreadsheet for this problem. So I'm going to share that with you. You should be able to see Excel problem 20-1B. In chapter 20, we're going to be discussing process cost accounting. And what process cost accounting is it's a type of accounting that we would use for a manufacturing business that is creating products that are so similar in nature that you can't distinguish one unit from another unit. Things like creating ice cream. 1 gallon of ice cream would be hard to distinguish from another gallon of ice cream. This would be an example of a company that uses process cost accounting systems. We're manufacturing units that are hard to distinguish one unit from another. A paper manufacturing company would use process cost accounting system. A steel manufacturing company would use a process cost accounting system because basically what they're doing is putting their materials through a process to get an ending type of product. In other words, in a metal manufacturing company, we would probably need to melt the metal and put it in some kind of molds and then form it. So the metal has to go through a process to be able to end up with a finished product. The same is true for your paper manufacturing. We would take the wood, the pulp wood, and put it through a process until it emerges as paper. So in a process cost accounting system, we're going to manufacture units that are very much alike in nature. That's different from the job order type of cost accounting system that we did last chapter, where we were manufacturing products that were custom types of products. You might recall from chapter 19, when we talked about job order cost accounting system, with every order that we got, we kept up with a job order cost sheet or a job cost sheet for each order. And on that job cost sheet, we kept up with the amount of the materials, the labor, and overhead for each individual job. Well, in a process cost accounting system, we don't have job cost sheets, but we will keep up with the work in process, the materials, the labor, and the overhead in a work in process account for each one of our departments. So in a process costing accounting system, each department would have its own separate work in process account. Each department also has its own separate factory overhead account. Whereas with a job order cost accounting system, we just had one work in process account where we put all of the cost into that work in process account. All the manufacturing cost went into the job order work in process account for materials, labor, and applied overhead. And then we would transfer those out of the work in process account and into finished goods. But with a process cost accounting system, we keep up with our work in process in each department. So each department would keep up with its materials that is used during an accounting period, the labor that was used during an accounting period, and the applied factory overhead. Each department has its own work in process account where the manufacturing costs are kept up. Then at the end of the period, we will take out all of the finished items in one department and transfer it over into the next department as beginning inventory. So in process cost accounting, we keep up with cost by department. Each department sends their cost to the next department. So if our materials enter in a work in process called mixing, I think in your chapter they were mixing some form of frozen yogurt or frozen ice cream. And what they used as an example was a company where they had a mixing department and a packing department. And so all the materials would go into the mixing department, and the mixing department would mix up all the frozen food materials, like the materials might be sugar or milk or probably some type of fruit if you're making ice cream, and it was a fruit flavored ice cream and you could add fruit to it. But your materials would go into the mixing department where it's all mixed up. And then it would be transferred to the packing department. And I guess in the packing department, that's where you put it in the containers before it is shipped. And at some point in time, of course, it needs to become frozen. So I imagine in the mixing department, it would go into the freezing department, which is probably the packaging department. And then it's going to be packaged into each individual container, and then it waits till it's shipped out. So I guess what I'm trying to say to you is we're going to be transferring units from one department to another department until it enters the finished goods inventory account. So in other words, we'll add up all the cost and work in process on the debit side. We would credit work in process for the finished units, and then we would debit that to the next department's work in process to transfer it to the next department, where we would add materials, labor, and overhead. And then when we're finished with that in the department, we would transfer it from the second department into, let's just make it simple and send it into finished goods. So we're going from department to department to department until the product is finished, and then it enters into finished goods. In this problem, what we're going to be looking at is a company called Preston Grover Company, and we're going to be manufacturing powdered detergent. And phosphate is a material that's placed into process in the making department, where it's going to be turned into granulars. The output of the making department is going to be transferred to the packing department, where packaging is added at the beginning of the process. And on July 1st, Preston and Grove Company had the following inventories. So they already had some beginning inventories for finished goods. This is a company that's been in business for a while. So that finished goods inventory amount would be debited to the finished goods ledger account. They already had work in process for the making department, work in process for the packing department, because in a process cost accounting system, we'd have a work in process inventory for each one of our departments. These were beginning inventory amounts for the work in process. We also had some materials that we had some beginning inventory for too. So later on, we're going to show you the ledger accounts where I put on the spreadsheet as T accounts, and I entered those balances in. I'll show you that in just a little bit. But all of these accounts had some beginning balances to start with. We're going to be doing the manufacturing operations for the month of July. And in transaction A, we purchased some materials on account for $149,800. What they wanted you to do is to journalize the regular transactions that occurred throughout the month of July. And so we're going to be our transactions. And what I mean by doing the transaction, we're going to be putting them in the journal first. Then, of course, we would post from the journal to the ledger. And then, of course, we would prepare our financial statements, basically. So when we buy materials on account, our materials, which is an asset account, is increasing. To increase materials, we would debit it. We bought 149,800, so we're going to debit our materials account for 149,800. We purchased these materials on account, so we have created a liability account called accounts payable, and our accounts payable has increased for 149,800. So we enter it into the journal first. In the B part of the transactions, they are telling you that you have some materials that have been requisitioned for use. What requisition materials means is we're taking some materials out of the materials account and placing them into process. You might remember from the instructions that phosphate was a type of material that was going to enter into the process. It's a direct material, and so it's going to enter into the making department first. So what we do is we take our direct materials and debit them into the work in process making department for 105,700, and that was the phosphate that we are taking out of materials and placing it into production. So our work in process making department would be debited for the amount of the materials that were added to the process, which was 105,700. We also had some materials that we gave to the packing department at 31,300. These materials would enter into the packing department. So work in process is going to be debited to the packing department for the amount of the materials and packaging, which was 31,300. We also had some indirect materials that we had to account for. Indirect materials, just like in the last chapter, are going to be your factory overhead. And what's different about this chapter than last chapter is each department has its own factory overhead account as well as its own work in process account. You can see that we put our materials into process in the work in process accounts for each department. Our factory overhead would be kept up for our indirect materials. We would debit factory overhead for the making department for the amount of indirect materials that went into the making department, and that was 4,980. Our factory overhead was debited again for the indirect materials to the packing department. Each department, again, has its own factory overhead account. So packing department is going to be debited for 1,530. All of these direct materials and indirect materials are going to be reduced or come out of the asset account. To reduce an asset, you would credit. So I simply added all my debits and I credited it to the materials asset account. And that's the journal entry to enter direct materials into process and account for indirect materials in factory overhead. In part C, they gave us some information about some labor that we had incurred during this time period. We had direct labor that was incurred in the making department for 32,400. We will debit our work in process for the amount of the direct labor, and it's going to the making department, so we're debiting it for 32,400. Our direct labor for the packing department is also debited to work in process at $40,900. Our indirect labor is considered factory overhead. So factory overhead would be debited to the making department for $15,400. Our indirect labor is factory overhead for the packing department. So factory overhead packing department would be debited for $18,300. All of these debits are added together to get our total credit, which would be to wages payable. Wages payable is credited for the amount of the direct labor as well as the indirect labor for this company. So this is the journal entry where we would record our labor. In D, we have a transaction where we are depreciating our fixed assets. And these fixed assets are going to be in the making department, the packing department. These are our factory assets that we're talking about here. And depreciation is an expense, and it would show up in the factory overhead account for each one of these departments. The amount of depreciation went to the making department, so factory overhead is debited for the making department at $10,700. Our packing department also had some depreciation expense. Since these are factory assets, our packing department factory overhead account would also be debited for the amount of the depreciation expense. The two of these added together are our accumulated depreciation for the factory. Accumulated depreciation is a contra asset account which has a normal credit balance. We're going to increase that on the credit side. So our two depreciation expense accounts are put into factory overhead. One is for the making department because we had some machinery in the making department that depreciated. The other one is for the packing department because we had some machinery in the packing department that depreciated. The two expenses added together will be the credit to the contra asset account accumulated depreciation. In E, we had some expired prepaid factory insurance. So factory insurance, just like any other insurance account, has to be adjusted at the end of the time period. We're going to take out the part that we have used for the factory insurance. Part of the factory insurance went to the making department at $2,000. So factory insurance is a type of factory overhead account. You would debit factory overhead making department for $2,000. You would also debit the factory overhead for the packing department. Let me get on the right place. Factory overhead for the packing department at $1,500 here. And the total of these would be credited to the prepaid insurance. The prepaid insurance is an asset account. It's decreasing in this case, and each one of our factory overhead accounts has to be debited for the amount of the insurance expense that each department used. For the F transaction, we are applying factory overhead. Remember, in the last chapter, we learned that we have to estimate our factory overhead at the beginning of the accounting period. Our applied factory overhead was estimated for each one of these departments here. And so once we apply the factory overhead, we're going to increase the work in process account by the amount that was applied. So the making department had applied factory overhead of $32,570. We will debit our work in process, the making department, for this $32,570. Our packing department had applied factory overhead at $30,050. We debit the work in process for the amount of the applied factory overhead for the packing department at $30,050. We would credit our factory overhead account because when we apply factory overhead account, we reduce the factory overhead account. The applied factory overhead account, the estimated amount goes on the credit side of the factory overhead account. We're doing this for each department. So factory overhead making is credited for the $32,570, and the factory overhead packing is also credited for the $30,050. We credit the factory overhead, we debit the work in process. So we transfer this out of factory overhead and put it into work in process. And then in G, it says the production costs are transferred from the making department to the packing department. So we're at the end and we have finished the items in the making department. So we're going to credit our making department, because when we credit the making department work in process account, we're reducing it and we're transferring it into the work in process for the packing department. So it could be finished in the packing department, and then we'll send the packing department's amount that they finish in that work in process account to finished goods, which is what happened next. The production costs are transferred from packing to finished goods. So finished goods is going to be debited for the amount that was transferred into finished goods from the packing department. The packing department work in process will be credited for the amount of the finished goods. And then we transfer from the finished goods to the cost of goods sold, the amount of goods that we have sold. Now, they only made one journal entry here, and technically there should be 2 journal entries, but they didn't give us enough information to know how much we sold the inventory for. So there would have been another journal entry where we would have debited accounts receivable and credited sales for the selling price of the inventory that we sold. But what they did tell us, they didn't tell us that information. What they did tell us is what we sold, and this is what it cost us to produce the amount that we sold. So we would debit our cost of goods sold account, which is an expense account, and we would credit our finished goods inventory. So in other words, we start in materials, we transfer our materials to work in process. When we're finished in one work in process department, we transfer the amount out of the first work in process department to the second work in process department. And then from the second work in process department, we transfer it to finished goods. That's the way it works with process cost accounting. And this basically took you through all the entries for a time period. And the second part of this problem, they wanted you to post the entries from above to these ledger accounts. The beginning balance was given to us. And so if you click on this first part that I've got illustrated for you, you could go back to cell C7 and you can see where I've got the beginning balance. It was given. And then what I did is I posted each one of my journal entries to my ledger accounts, and I've labeled them by transaction. So you can see in transaction B, we had a debit for $105,700. This was your direct materials. Your direct labor was debited for $32,400. Your applied factory overhead was debited for $32,570. Then at the end of the period, we transferred some of these units out of this work in process and put them into this work in process. We also had a beginning balance, that's not the right spelling there. So let me change that to BEG. Unfortunately, with Excel, I don't know how to check spelling. So you might see some misspelled words on my worksheets, but hopefully they help you anyway. The beginning balance was given. The work in process in the packing department, they added some direct materials, some direct labor, and some applied factory overhead. And they also added as a debit what was transferred from the making department. All of these debits are combined and subtracted from the credits that went out into the finished goods account to find the ending balance. So we added our debits, subtracted our credits to get the ending balances of these accounts. In the ledger, it's the same thing. The T account just makes it a little bit shorter for you to see. And so all we did is we posted our journal entries from above into our ledger accounts, and we balanced those. Materials, which is an asset account, should have an ending debit balance. Finished goods, which is also an asset account, has an ending debit balance. And then in the last part of this problem, they also wanted you to compute the balances for the factory overhead accounts. Again, I copied from the journal to the ledger accounts to see what happened to our factory overhead accounts. Each one of the transactions is labeled B, C, D, and E in this case. I added up my total debits and I've compared it with my credits. In the factory overhead account, it's possible to have a leftover debit balance, because remember, when you credit your factory overhead here from transaction F, you're applying the factory overhead. You're estimating the amount of the factory overhead. The amount that we estimated was less than what the total of our actual factory overhead was. Our actual factory overhead is $33,080. We would subtract our estimated amount from the actual amount, and that left us with a debit balance, which is a negative balance in the factory overhead account. This negative balance is what we call under-applied factory overhead. Under-applied just means that our total credits was less than our total debits. So we have under-applied factory overhead. We did not estimate enough to cover our actual factory overhead expenses in the making department. In the packing department, you do the same thing, but in the packing department, the total debits were less than what we estimated for the credits. That left us with a credit balance in the factory overhead account for the packing department. And we call that credit balance an over-applied factory overhead balance, because the over-applied amount means that we estimated more than what we actually had in factory overhead. So we had some over-applied factory overhead as the balance. We would carry this factory overhead balances in both of these departments till the end of the year. Once we get to the end of the year, we will close out the factory overhead account and transfer it into cost of goods sold. They did not ask us to do the journal entry for that, but I do think it's important that you know that the under-applied or the over-applied factory overhead balance has to be transferred to cost of goods sold. So when it's closed out at the end of the year, they did not ask us to do that, so I didn't show you how to do it, but I do think it's important that you know how to do that. So I wanted to talk to you about it at least. So that's all I want to talk to you about today. I'm going to stop sharing this with you, and I will post the Excel spreadsheet with the video so you can go back and look at it as you deem necessary. So hope you have a great day, and I'll see you next time. Bye-bye.